All right, today we're breaking down the Q3 earnings for Parks America. Now, when these numbers first hit on August 11th, they looked like a total snooze fest. But what happened just a couple of days later? Well, that tells a much more interesting story. And honestly, it's a great lesson in why you've got to look past the headlines. So, this is the big mystery. On the day of the earnings call, the stock did nothing. It closed totally flat. But then, just 2 days later, boom, it rockets up almost 17%. So the big question is, what did the market suddenly figure out? What was hiding in plain sight in those numbers that took 48 hours to sink in? You can't really blame the market for being confused at first, because when you just glanced at the results, the picture was, well, it was messy. The main top-line number was anything but exciting, and that's exactly why the stock just sat there. And here it is. This is that huge disconnect I was talking about. You look at the revenue line. It's up less than 1%, basically totally flat. But then your eyes drop down to pre-tax income and, wow, up over 1,100%. This contrast right here, that's the whole story. How in the world does a company with zero sales growth generate that kind of insane jump in profit? Well, the answer is all about two key things that you just couldn't see in the headline numbers. We're calling it the story of mix and cleanup. It's about what wasn't in the results this year and what was performing like an absolute rock star under the surface. So here's the deal. Last year's Q3 was seriously dragged down by some big one-time costs from a nasty legal battle with activist investors. That's the cleanup. Those costs are just gone now. So this quarter looks way cleaner. And at the exact same time, you have the mix. The Texas park just delivered a monster 43% revenue growth. It's become the company's main engine. This chart really shows you that mix shift in action. I mean, look at that. The Texas park's incredible 43% growth was so strong it completely papered over the weakness in Missouri and Georgia. That's how you end up with a flat top line. But what's happening underneath is this super high-quality growth from a key asset that is just firing on all cylinders. Okay, so the numbers tell one part of the story, but you've got to listen to the Q&A session with management to get the full picture. And honestly, what they said was just as important as the financial results for figuring out where this company is headed. So the company president, Jeff Gannon, basically came out and said, hey, don't just look at ticket prices. He really wants investors to focus on the total per capita spending. That means tickets, food, merch, the whole shebang. Because that's a much better sign of the business's real health and whether they actually have pricing power. And you know what? The call was also incredibly honest. Management was very clear. Their strength is in running the parks efficiently. They know how to run a tight ship. But they were also really blunt about their big historical weakness, marketing. The huge takeaway here is that they are now building an internal team to finally fix this problem, which creates a really clear catalyst for growth going forward. Okay, let's tie all of this back to that initial mystery, that 16.7% pop. Why the 2-day delay? Well, it's because the market had to digest this whole story. It had to process the shift from a messy, flat revenue company to a clean, highly profitable execution story. And here's pretty much how it went down. On August 11th, the algorithms and the headline skimmers saw 0.8% revenue growth and just moved on. The stock went nowhere. But over the next day, the real analysts and the dedicated investors, they dug in. They saw the clean P&L, they saw the Texas growth engine, and they realized those one-time costs were gone for good. By August 13th, the story had been completely rewritten, and the stock got re-rated higher to reflect this much better quality of earnings. All right, so that explains what just happened. But we're investors, right? We care about what's next. So let's talk about the next earnings call and what a potential trade idea could look like based on everything we just learned. This is really the core question for anyone thinking about investing. The noise from that proxy fight is gone. The balance sheet is clean. We can finally see the underlying business clearly. So from here on out, this is a pure execution story. It's all on them. So based on this whole analysis, our rating on the stock is outperform. We think the market is still underestimating the kind of operating leverage that's about to be unlocked here. So here's the thesis. First, that cost cleanup we talked about, it sets a new, much higher floor for how profitable this company can be. Second, the Texas park is a proven growth machine. Third, if the other parks just stabilize, they don't even have to grow much. That provides some serious upside torque. And finally,
That new marketing push is a really low-risk, high-reward shot. Any new dollar of revenue from here should drop to the bottom line at a very, very high rate.
So, the trade idea here is to go long Parks, America, maybe picking up shares on any dips. The key thing you're going to want to watch for next quarter is simple: continued strength out of Texas and any comments they make about early wins from that new marketing team. If they can execute on that, we see a clear path to the $45 to $50 range over the next 6 to 9 months as the rest of the market catches on to this new, leaner, more profitable story.
You know, the Parks America story is a fantastic reminder that sometimes the real story isn't in the headline. It's buried a few layers deep. The question now is whether this new marketing team can capitalize on the clean slate they've been given. This is not financial advice.